Recently, I had a very interesting conversation with an experienced investor. The way he explained things really changed how I look at investing. I want to share those lessons with you in a way that's simple and easy to understand. If you are new to investing, or even if you have been investing for years, these lessons can give you a new perspective. Here's the first lesson I learned from him: know your end game. He started by asking me a simple question: why are you investing? At first, I thought the answer was obvious. We invest to make money. But he explained that it's not just about making money, it's about what the money is for. For example, are you saving for retirement? Are you building a college fund for your kids? Do you want to buy a house? Or you just want to build wealth and become financially free? Each goal is different. If you are saving for retirement 30 years from now, you can take more risk because you have time to recover from market ups and downs. But if you need the money in 2 years for a house, you can't afford to take that much risk. So the lesson here is know your end game. Before you buy any stock, ETF or crypto, ask yourself, what is this money for? The answer will guide what kind of investments you should make. The second lesson I learned is diversification is about more than just stocks and bonds. A lot of people think diversification means just owning a mix of stocks and bonds, but he explained it's much bigger than that. Diversification means spreading your money across different types of assets so that if one goes down, you don't lose everything. For example, stocks give you growth, but they are risky. Bonds give you safety, but sometimes very low returns. Real estate can give you steady income, but it ties up your money for a long time. Even if cash is a part of diversification because you need liquidity. And here's something important he said: diversification isn't only inside your portfolio, you also have to look at your whole life. If you already own a house, that's a big investment in real estate. If you run a business, that's another type of investment. If your spouse has a pension, that's guaranteed income in the future. So don't just think I own 3 ETFs, so I'm diversified. Think about the bigger picture: all your assets, your job, your family situation. That's your real diversification. And here's the third lesson he taught me: the hidden risk in bonds. Many people think bonds are always safe. He said the risks with bonds isn't always obvious. It's about concentration. What does that mean? When you buy a bond, you are lending money to one company or one government. If that company defaults or inflation goes high, your bonds might not protect you as much as you think. Stocks, on the other hand, are pieces of hundreds or thousands of businesses. So, in one way, stocks are already more spread out. Does that mean bonds are bad? No, but you should understand the risk. Bonds can be safe in some situations, but they can also lose value if inflation rises or interest rates changes. So don't just assume they're always risk free. And here's the fourth lesson: look at your whole life cycle. This one made me stop and think. He said investing changes depending on where you are in life. When you are young, you can take more risk because you have time to recover from mistakes. That means you can invest more in growth stocks or ETFs. But as you get older, your focus shifts. If you are closer to retirement, you want more safety. You cannot afford a big stock market crash when you need your money soon. So your portfolio should look different at 25, 45, and 65. And beyond age, your job and family also matter. For example, if you have a stable government job with a pension, you can take more risk in your investments. If you are self employed with no guaranteed income, you may want more conservative investments. So, look at your whole life situation when deciding how to invest. Lesson number 5 is estate planning, the most overlooked part. This is something most investors don't even think about it. What happens to your money after you're gone? He asked me, what good is building wealth if you don't know where it's going after you? And he's right. If you don't have a will or a plan, your family may struggle to access your money. Legal battles, taxes, and confusion can eat away what you build. Estate planning is not only just for the rich people. Even if you have a small portfolio, a car, or a house, you need a plan. A simple will or beneficiary designation can make sure your loved ones get what you intended. It's not too fun to think about it, but it's part of responsible investing. And here's the sixth lesson: valuation matters. Don't chase every rally. Another thing he said was if you buy a stock when it's too expensive, you have already lost half the game. And it's true. You might love a company, but if the price is way higher than what it was worth, your returns won't be good. This is why valuation matters. Valuation means is the stock cheap, fairly priced, or overpriced? For example, if a company is growing fast but the stock is already priced as it will grow forever, you may not make much money even if the company keeps growing. And the lesson here is don't get caught up in hype. Be disciplined. Great companies can be bad investments if you buy them at the wrong prices. And lesson number 7 is luck versus skill. He reminded me of something we all forget. Every portfolio has some luck in it. If you bought Tesla or Nvidia years ago, you did really great. But a big part of that was timing and luck. Skill is about having a system, researching companies, diversifying, and managing risk. Luck is when the timing works in your favor. The danger is confusing the two. If you think all your wins are skill, you may take bigger risks than you should. Recognizing luck keeps you humble and cautious. Lesson number 8, what I learned was don't ignore alternatives. Finally, he said stocks and bonds are not only the only investments. He mentioned gold, crypto, and even commodities. These are not the core of a portfolio, but they can play a small role. Why? Because they behave differently than stocks and bonds. For example, gold often goes up when stocks go down. Crypto is risky but can grow very fast. The idea is not to put all your money in these, but having 5% in gold or a little in crypto can protect you when things go wrong in the stock market. Think of it like insurance. And here are my final closing thoughts. So, what did I learn from this conversation? Investing is not just about making money, it's about knowing your goals, protecting your family, diversifying smartly, and staying disciplined. It's not about quick wins, it's about building wealth that lasts and supports your life. I hope breaking this down step by step made it easy to understand. Even if you are just starting out, these lessons can help you avoid mistakes and invest with confidence. And if you found this video helpful, please like the video, subscribe to the channel. Thanks for watching, and I'll see you in the next one.